Hello everyone, my name is Vikas Agrawal and I am the founder of AIF and PMS Experts India. So AIF is your alternate investment funds and PMS is nothing but portfolio management services. A lot of people I think don't know much about this particular segment. So AIF starts with 1 crore, the minimum threshold defined by SEBI, and PMS starts with 50 lakhs. That is the minimum threshold defined by the regulator, but there are PMSs. They further decide how much money they want to accept, what is the kind of mandate they want to take. So there are PMSs where, gone ahead and said that they will take minimum 2 crores. And there are PMSs where they take minimum as 10 crores. That's the bare minimum expectation they have. And apart from that, they also work closely with some of the large family offices. So we thought we'll try and understand this subject more in detail. And the second thing which is most important is I keep meeting a lot of investors, and one question that I get is, how do I get 25-26% kind of returns for long period of time? So today we'll discuss that with my friend Mr. Prithipal. Prithipal has more than 2.5 decades of rich experience when it comes to asset management business in India. He has worked with large organizations like Reliance Mutual Fund. Earlier Nippon used to be Reliance Mutual Fund. Then he has also worked with BNP as head of sales, and then he has joined a boutique, I would say, a boutique PMS portfolio management company called Aequitas Investment Advisors. So thank you so much, Prithipal, for accepting our request and taking the time out from your busy schedule and agreed to speak to our investors.
Thanks, Vikas. Thanks for the opportunity.
Right. So, Prithipal, you have now 2.5 decades of experience. You saw mutual fund industry growing.
Yes.
In front of your eyes. I remember in 2013, the total equity portion of large put together all AMC used to be less than 2 lakh crores.
Yes.
As we speak, it is 22 lakh crores.
Yes.
And same thing is happening in now AIF and PMS also.
Correct.
This piece is growing very fast.
Correct.
And a lot of investors are sort of getting into that.
Correct.
So first of all, let me congratulate you for having completion of 10 years
Thank you
of your journey at Aequitas as an organization, and delivering 29.3% CAGR.
Yes.
It's a very big number.
Yes.
I mean, if your 1 crore is growing at 26%, 26.5% for 10 years, 1 crore becomes 10 crore 10th year, it becomes 100 crores 20th year, it becomes 1000 crores 30th year.
Correct.
People don't believe on this.
Correct.
So first of all, absolutely fantastic work done by you and your team, including Siddharthji. So we want to hear from you. How do we generate, and how do we, as an investor, how should I look at, how do I enhance these returns, and what is it that you think that I should have as an quality as an investor in order to achieve these numbers?
So thanks, Vikas. Thanks once again for the lovely words and kind words that you talked about. So let me give while you talked about 26%, 10 years, 1 crore becomes 10 crores. That's a lovely mathematical number. Very few investors are able to have it. Right. But I can proudly say that we completed 10 years with 29.3%, and in this 29.3%, our investors who've been associated with us, they have made 13 crores out of their 1 crore that they invested.
Okay, right? 1 crore has become 13 crores.
13 crores. So that's the incremental 3% on a 10-year basis. That's the kind of difference it creates.
Almost 30%.
Correct, in CAGR basis. Right. So why 29.3% is very important is because when we were looking at the best of fund managers, whether domestically or internationally, we found that there were only 2 fund managers who were able to generate a similar kind of return.
Okay.
Right. And you actually have to go really back in time. Right. So Warren Buffett used to run something called Buffett Partnership between 1957 and 69.
Right.
That's the time that he generated close to around 29.6 or 7% kind of returns. Right. Then there was the famous Peter Lynch when he was running Fidelity Magellan between 77 and 1990. he again generated close to around 29.5% kind of returns.
Sure.
Right. So since then, we are yet to come across any fund manager, whether domestically or internationally, in the long only space, who's been able to generate this kind of a return. Right. So one, it is actually a very, very big feat.
Yeah.
Now, interesting thing is that inception till date, I'll talk about the PMS because this is the PMS data.
Right.
We started off with close to 138 odd folios on the PMS. Inception till date.
Okay.
And till date, we have 131 of those folios still active with us.
Okay.
That means in 7 years' time, wherein we've seen demonetization, we've seen 2013 February freeze, where we've seen GST, where we've seen COVID, and just about everything. And the rampant money printing that has caused the inflation, so many other aspects,
Ups and downs. Yeah.
ups and downs that one would see more in a lifetime or possibly more. COVID was once in 100 years kind of
True.
thing, right? The investors have stuck around and been the beneficiaries of this kind of a return. Now, second question, right, which was the more pertinent one that you were talking about, is what exactly does it take to generate these kind of returns? Right. So truth be told, the entire fund management team is, I believe what they do out there is phenomenal, right? The most important thing that we do is we stick to our investment philosophy, right? And our investment philosophy is sticking to value. That's the most important thing. If at all you are buying a company where the intrinsic value is greater than the market value, right? That's when you actually have a product wherein you can actually start seeing price realization coming. There's no fun in getting into a company which is known by everyone, and it's right top of the name, recall and expect 20-30% kind of returns. Like, I'll give you an example, right? And these are fads that keep on happening. So 98 onwards, right, between 98 and 2000, we actually had the tech boom. Very few people realized that along with tech there was one more sector that was actually doing the rounds very well. It was the FMCG sector, right? So FMCG sector and tech were the only two sectors that actually did well in 98-2000. Now, while one can understand that post the dot-com bust, tech could have gone down, right? But there is no explanation to the fact why exactly did Hindustan Lever, from 98 when they split their 10 paid up to 1 paid up, for the next 7 years, it was stuck in a band of 330 to 170 rupees. It didn't move. So when people say that buy right, sit tight, just to take an example, there is nothing called till perpetuity. You have to be in the right stock at the right time, right place in the right time,
right,
and then ride it through.
Right. So just want to interrupt here and ask you one question on behalf of our investors. When you say value investing, so at times it has been observed that our Indian market continuously goes ahead in line with growth investing.
Correct.
And value doesn't work for 2-3 long years.
Correct.
That is a time. How do you manage your clients?
So this is a very interesting thing. See, because US is a far more developed market, I'll take that example only. Barring the period between 2008 and now, you actually had a situation wherein value was always doing better than growth, even in the US, right? While in India, it was always a situation wherein growth was always being given a far better PE multiple, right? And it was doing far better than value.
Yeah, it's a growth-oriented market.
Ours is a growth-oriented market. But in spite of that, so I'll tell you the 3 pillars that we are actually, really standing on. While we did talk about value, the second one is growth. It doesn't mean that in chasing value, you do not look at growth. You have to have an above average growth. You have to have an above average visibility of at least the next 3 to 5 years, because there's nothing better than the markets rewarding growth. And the third thing is contrarian. You can't have the same names that the rest of the world has. Right. I'll give you a very interesting data.
So your investment philosophy includes all these 3 pillars.
Yes. These are the 3 pillars.
So you're open and flexible. You don't have a sort of very fixed that I would stick to value, or I am a growth guy or a contrarian guy.
No. So all these 3 put together. See, value is the most important, right? Growth is the second most important, and being contrarian is the third most important, right? Not necessarily giving weightages to the 3, but these are the 3 pillars on which the entire investment philosophy stands. Now, the second thing, I'll give you one very interesting thing, contrarian mein. The top 100 companies, which are the large cap companies, on an average, take a wild guess how many analysts are covering those companies.
Top 100, so I'm sure the entire state is covering that.
Exactly. Around 72 odd people,
Right.
analysts, right? So there's nothing to be discovered in those large cap companies, right?
Yeah.
Now let's come down to the mid cap companies, 101 to 250.
Yeah.
On an average, how many analysts do you think are going to be covering those companies?
So I think percentage would be just half than what.
It's closer to around 24, 25. But all these 24, 25 are very, very sharp brains, right? They would leave no stone unturned in trying to figure out if there is anything missing or not, right? So again, everything is out there in the open, right? So institutional coverage is equal to price discovery. The minute there is price discovery that has happened, that first bit of alpha that you are able to generate, right, you are not able to generate, right? Then you get only linear returns, right? Now what we do is, again, one more question. Number of companies which are in the sub 5,000 crores market cap space. How many analysts do you think are covering those companies?
Very less, I know. I know the fact that they're very less.
Yes. So to give you a number, I think the number of people that are covering sub 5,000 is 0.2, 0.3, something like that.
Yeah. So you're talking about the organized analyst, the research-driven organized.
Yes. Right. So this is where the value lies. So what we do is, I've talked about the three pillars. The second thing that we do is that we do not subscribe to secondary research.
So you have your own primary.
Yes, we have our own primary
research. You do complete channel check, promoter discussion.
Everything.
On your own.
Everything.
So how big is your investment team?
So we have a team of 7 people, right, in the investment side. All of them are chartered accountants. All of them are rank holders.
But is it doable for 7 people to have so you have, I think, more than 6,000 companies listed put together, out of which, even if you're covering say 1,000 or 1,500,
so we have a soft coverage on close to around 350 odd companies. We have a hard coverage on close to around 60-70 companies.
Nice. That's right? Your main universe.
Yeah, that's the universe. See, screener helps us shortlist the right set of companies, right? So coming to the fund management team, right? All of these guys have either MBAs or CFAs, right? And the entire investment philosophy is ingrained in the system. So there are lots of don'ts that we do. Right. Do's तो सारे बताते हैं, मैं आपको don'ts बताता हूँ. Like we will never invest in a IPO. We will never invest in a QIP. We will never invest in an FPO. Right. We will never invest in a company wherein the promoter shareholding is low. We will never invest in a company where institutional shareholding is significantly high. We will not invest in companies which actually have a significantly large number of analysts covering that particular stock. Right. We will not invest in a company if it is not a market leader. Right. Market leader is defined as market leader either by percentage of sales or by margin that it has. We will not invest in sectors.
High-rate companies.
Yeah, high-rate companies. We will not invest we will invest in cyclical companies. Right. We will not invest in sectors which are currently the fad sectors. What we'll do instead is we'll invest in the largest company in the most boring sector at that particular point in time. Because that boring sector is the one which has not seen investments over the past 5, 6, 7, 8, 9, 10 years. Right. I'll give you one very interesting
So it's
example.
both top down and bottom up.
Yes.
The approach.
Yes. It starts with the bottoms up, right? But we also have a peek into top down as to what exactly is happening. One very interesting number that I'll give you. Pharma as a sector, right? Mr. Dilip Shanghvi was crowned the richest Indian sometime around in 2013 or 14.
True.
Right. Since then, there's nothing really that has happened in the entire pharma
It's going down.
But it doesn't mean that the companies are bad, right?
Yeah.
It just means that the sentiment turns are.
Yeah.
Right. So, but what happens is, till when will this happen? Right. So those are the things that we look at. I'll give you one very interesting example. We created a portfolio which was, focused on infrastructure and capex oriented stocks sometime around 2017-18. Right. Since then, we haven't really changed our portfolios. Right. It's the same companies. While the world has seen, COVID happen. Right. COVID related deflation first, then COVID related inflation first. We have stuck our guns. Right. We've just had the same portfolio. We just kept on adding on a couple of leaders in a few other sectors.
Sure.
But
so how many companies typically you manage?
So in our PMS, we create see, the reason why we have that 10 crores that we were talking about initially and you mentioned is because we create bespoke portfolios. So when we create a portfolio in the PMS side, we'll create a 16 stock equal weighted portfolio.
16 stock?
Yes, 16 stock equal weighted portfolio.
So you believe in concentration?
We believe in the right amount of diversification. Right, we don't believe in having anything more than say 25, 30, 40, 50, 60 stocks. That's there in the mutual fund space. I mean, if you're diversifying so much, we believe that you're not really very sure of the bets that you're taking. See, right sizing of bets is also very important.
True.
Right. The second thing that we do is,
but when your universe is so big, then don't you think the 16 numbers becomes very less as compared?
So when we are talking about the hard coverage universe of 60, 70 stocks, what happens is that at any given point in time, when I'm talking about say one PMS, which is a bespoke PMS, right? Today the 16 stocks will not be the same as the ones that I picked up say 6, 7, 8 years ago. They'll be different. Right, so the overall
therefore
number of
you
stocks,
take minimum 10 crores and work closely with the investor.
Yes. So the on an average, if you were to look at the overall expanse of the stocks that we would have across all our portfolios, will be in the range of anywhere between 35 to 38 odd stocks.
So my question is that the major question which we want to drive here, is that you've seen, I'm sure in last 10 years you would have seen some underperformance also. Everybody has their own share of underperformance.
It's a part of being a market.
Right. Now what is happening is, for example, today in 2023, we've seen people are not able to make money for last 1.5 years.
Correct.
18 months.
Correct.
Well, I'm not sure about your PMS, but that's the common phenomenon.
Correct.
Now, question is that when I talk to investors, they expect 25% kind of returns.
Sure.
But the moment they don't see returns coming in, that is the time they withdraw, and that is where the accident takes place, especially in AIFs and PMSs, unlike mutual funds.
Correct.
So while this industry is growing very fast, one of the limitation is that because it is a large sum, investors keeps on looking at the same portfolio, and one day he gets frustrated, become emotional, and sells the portfolio and realize that he made a mistake.
Correct.
So what are your thoughts on these?
So in any investment, right, whether you do it on the mutual fund side, whether the PMS or the AIF side, you got to give it time, right? You actually have to give it time. Now in a mutual fund, what tends to happen is, what you see is the NAV, right? And mutual funds have a different set of challenges. They have to battle with the nifty growth on an everyday basis,
daily basis,
right? PMSs do not have that challenge, but at the same time, what tends to happen is that when you're looking at the stocks, typical human nature is that and it's logical as well. What you'll not see the winner. What you'll see is the biggest loser and say, why exactly are you invested in this particular stock, right? And more often than not, that is what causes pains to the investors. What we do from our side is that whenever we are seeking out investments from any investors, the first thing that we talk about is what is it that we do, what is the kind of risk that is there, right? And what is the risk mitigation process? The risk mitigation process is time, right? Like I'll give you and typically whenever you have companies which are very deep value companies, right? For example, there are few things that we look at. One is something called price to sales, right? A lot of times the price to sales of our company portfolio is 1, right? That means to give you an example of how exactly the rest of the market is perceiving this, there was a very large B2C company, D2C company that actually got listed. They had a price to sale of 200, right? उसमें प्राइस टू सेल्स में उनका मार्जिन था, पैट मार्जिन 2% का था, तो पीई रेशियो कितना हुआ उसका 4,000 40,000 whatever, right? So that's the thing that we are very wary of. What we are looking at is, if you are looking at a price to sales of 1 in our portfolio, largely you will see that our portfolio PEs will be around 10, right? So when you have value with you, and typically in India kind of an environment when you have a steady inflation of anywhere between 4 to 6%, right? Results are always nominal, right? So you'll always tend to have a return profile which is positive if everything is linear, right? Yes, there is going to be sentiments, whether systematically driven sentiments, which is market driven sentiments, or whether some other sentiments which will actually cause the valuations to jack up sometimes and valuations to come down below also, right? When it comes down below, that's the time that we start looking at whether the thesis is right, whether the portfolio that we've created is right, right? And that's the time that we have to engage more with our clients.
Right. But what if your portfolio continues to underperform for 2 long years or 2.5? Sometimes it happens. When
Yes, it happens.
The kind of approach that you have.
Correct.
Like for example, between 2018 to 20, you look at small cap index was down by good 40%.
Correct.
So that is a time when you get this question from your investor, and mostly they're all promoters.
Yes.
How do you handle that?
See, very honestly, you have to walk with them, right? The most important thing that is there is that, we are one of the largest investors in our own AIF, right? A lot of our wealth is actually there in the AIF. So we are actually sailing the same boat. So for a lot of promoters, what tends to happen is that, they would have a very small fraction of their wealth with us, right? But our entire wealth is there, right? So structurally, what we are looking at is, what I've realized is that most investors are seasoned investors, the category that we are talking about.
Sure.
Right? And the minute you handhold them, you walk them through, you take them through as partners, rather than have a manufacturer-client relationship at that particular point in time. Right?
Well said.
That's the time that the clients also understand. Okay, let's give them some more time. Let's see how
because they are very educated investors.
Exactly.
Or they have really created something big in their life.
Yes.
Some amount of handholding would help them.
Yes. Right. See, I can, if you think of any promoter, there is not one promoter in the country who's not seen ups and downs of his life, right? And he understands that. If that can happen in a business which is a bricks and mortar business, right? This is actually, it's like a very, very long pendulum. The smaller pendulum will have a smaller swing, which is what is the economic cycle, right? Then will be the business cycle, which will be slightly longer swing. Then is the profitability cycle, which is still longer. Then there is the emotional cycle, which is the share price movement, which is a still longer cycle.
Right. So coming back to one more question, Prithipal, before we conclude the session.
Sure.
So, what is small cap investing according to you? As in, what is the kind of stomach people should have when they approach small cap investing? If you can define in terms of percentage, nothing like it, or just please share your experience.
Sure.
And whether somebody really should invest in small cap, and if yes, then what should be the realistic age?
Correct. So, first of all, I'll tell you something. There was a very interesting question that was asked to us some time ago, right? Whether small cap is actually a diamond mine or a coal mine, right? So what we believe is, it's actually a coal mine, right? You got to dip deep, right? Because it's only coal under pressure that is a diamond, right? Right. So that's the most important thing, that you have to really dig very deep. You have to have a very, very strong research. You have to have a very, very strong stomach. Right, and you have to stay with your conviction for a very long period of time.
Which is more important?
So I'll give you a very interesting perspective. On an average, our average holding period in our PMS is roughly around 6 to 7 years.
Oh,
average. This is the average. So there are some stocks that we haven't sold since the time we bought them.
Sure.
Right, and there are few stocks that we've added. Right. So when you have this kind of a conviction, you're not really buying a stock. You're participating in a business, right? And how do you participate in a business? You participate in a business only if you know what the businessman is all about. In fact, one of our keys to research process is that we will look at companies only which have a minimum of 7 years of publicly listed life, right? Those 7 years give us what? Those 7 years give us quarterly analyst con calls 28 times, right? Every quarterly analyst con call is 1.5 hours. So 28 into roughly around, say, 15 is roughly around 400 hours. In 400 hours, you are getting to know quarter on quarter what exactly is happening as far as the management is concerned. You get to know management competence, you get to know management, how exactly are they doing their capital allocation, how aggressive they are in giving projections, how committed they are to what exactly have they said. Whether they agree that yes, this is where they went wrong, and they start taking corrective action. So you are actually betting on the management as much as you are betting on the business.
So you have to have that conviction.
Exactly. Also. Because 5-7 साल में क्या होता है? If there is suppose, just giving an example, there's a company which has a trading component and a manufacturing component. And what we are seeing is that the manufacturing component is rising a little, right? And we say that okay, let's start looking at this company carefully and let's understand. Now 5 to 7, 8 years time, the business mix could have been 30-70 could change to 70-30 or possibly remain 30-70. Right. But if it changes from 30-70 to 70-30 towards manufacturing, that's the time that the business has actually changed its EBITDA margins forever. Right. So those are the things that you have to look at.
So all that as an investor you need to understand.
Yes.
That. So I'll tell you, I've got about 20 years of experience in this, more particularly in AIF, PMS, because all my life I've been doing this only. I'll tell you where the major accident takes place, because people come with an expectation of 25% CAGR return.
Yes.
And when they get disappointed because they are expecting 25%, the portfolio is down by 25%. So you have a difference of almost 50%, versus your expectation versus the reality. And that is where they start questioning the portfolio manager, and they somewhere feel that they're being cheated by somebody, and then there is management fees which is going and all that. And that is where they take the decision and try to come out of it and put money with some other large cap guy. But by the time this large cap guy has already performed, he also underperformed, this guy also has already underperformed. Now the small cap guy is to perform now. So, and the investor is saying that यार PMS से पैसा बनता नहीं है और मेरे को बाहर जाना है.
So ये जब recency bias होता है ना, this is something that whenever we engage with clients, even before we onboard them, we specifically tell them कि अगर आप ये पिछले 2-3 साल का रिटर्न देके आना चाहते हो तो मत आओ.
Okay.
Right.
You tell them.
Yeah. There are times that we actually say that if you're looking at the previous 1-2 years returns, please don't.
We are not the right guys.
We are not, because see, we are in it for the long haul.
Sure.
Right. If you're looking at our 10-year returns and then saying that yes, over a period of 10 years, these guys have the ability to deliver better returns in the benchmark.
Sure.
Yes, definitely come to us. Right. But 1-2 years karke, because then what happens is you wanted to make that that fast buck. Right. There are times that we have a lot of patience. We've had companies in our portfolio which have not done anything for one particular company didn't do anything for 4 years.
Okay, and you held on to it.
We held on to it. In fact, the price went down by nearly 50%. But because the business model was right, we held on to it. Right, and suddenly there was this turn that was, and we were wanting to observe one particular turn that happened. The stock shot up by 30x, literally, 25-26x.
In a matter of what?
In a matter of 1 year, 10 months.
My goodness.
Right. So, and that's when we exited. Right?
So, what is the time horizon that you inform your client that when they are investing in small cap?
At least 3
People say 3 years, 5 years, 7 years.
At least 3 to 5 years. At least. And in fact, one more thing that we try to do.
I would say 7 years.
Absolutely right. In fact, what we do is we say that don't look at it as a lump sum investment. What you do is once you've given our initial investment, you've seen one particular cycle. Now whether you're comfortable on a monthly basis or a quarterly basis or a 6 monthly basis, keep on adding something or the other. Right? Because that laddering is something that will always keep you,
This is the most important aspect when you're investing in PMS. Because what happens in mutual fund, because you get a lot of inflow, the assets gets average out.
Yes.
But here in PMS, people should actually add up as in when the markets are down.
Correct.
And if market really gets into an exorbitant valuation, that is the time you can book some profits, 10-15%, whatever, if you wish to. And that is where we play an important role in terms of advising our client that this is how it should be.
Correct.
So you are looking at 7 years, that's the minimum time frame that
I would say minimum 3 to 5
years. 3 to 5 years, sure. Okay, my last question.
Sure.
So, you take minimum 10 crores in PMS, 3 crores in AIF. Any possibility you revisiting your thought process, because there are a lot of investors out there who come to me, they are keen to participate, but they really don't have that kind of overall investment portfolio.
So I'll tell you something. The reason why we actually have those numbers, I think. See, one is we are a very, very boutique player, right? We have a one-on-one relationship with our clients. We intend to keep it like that, right? So whenever we are reaching out to anyone, we know that we would want this journey to continue for the next 7, 8, 10 years, right? If we were to dilute our thresholds, what will start happening is that we will not be able to do justice to our clients, right? We will not be in a position to handhold them in difficult times. See, because investment is a phase wherein you will have great times, good times, and difficult times as well.
True.
Right? It is the true metal of any PMS manager or any team. comes forth only when you undergo difficult times. In good times, it's very easy. I mean, मेरे को कितना time लगेगा? I'll go to 5 large channel partners and say, boss,
open up and you start getting money.
Exactly, right? So that's not the deal. The deal is, you know, to be partners with our clients in whichever journey that we take.
Sure.
So we are very happy going in a slow and steady pace, right? Ensuring that we take the entire tribe together, rather than have a situation where, you know, you get lumpy money and, you know, God forbid if something was to go wrong, right? We will not be in a position to answer to all of those investors.
Great. With that, we would like to conclude the session here. Prithipal, thank you so much. It was pleasure interacting with you.
Welcome.
Great insights, and wish you all the very best.
Thank you.
Keep up the good work. Keep creating wealth for your investors, and this will create bigger name of PMS in our industry. So keep it up. Great contribution from your end and your organization. And so my great regards to your company.
Thank you.